Okay, today we are going to talk about various different tax forms that come into play in business, and depending on the type of business organization, what tax forms you have to file. And so we're going to start here on page 72, I think it is. And this is a list of various different tax forms that are pretty common in business activities. So I have the first four of them highlighted, and then we have some bottom ones. And I have this line right here. So let's start with what I mean by that. These top four tax forms involve income tax. Income tax is tax that is owed on the income of an individual that you make as a wage, if you're working for somebody, or other type of income like dividends or rent or whatever. And then in a business environment, this is tax that may or may not be owed by a business. And this is how you have to report every year to the IRS, and then you also have to report to the state of Oregon. I have not included the Oregon forms because they mimic the federal forms. Every year to report your income. So those are the top four. Now I have those highlighted because I want you for the test to be able to answer which type of form is filed by which type of business entity. And primarily it's these three here. So for a corporation it's called an 1120 form. For an S corporation, which of course is not subject to corporate tax, it's called an 1120S form. And then for a partnership, it's a form 1065. And so my test question, again, they're true, false, multiple choice. It's open book. What is the correct form number for a partnership for income tax? And that would be a 1065 form. What's the correct form for an S corporation? An 1120S form, etc. So you want to be able to turn to this page, maybe put a little sticky note or a bookmark on it, so that you can turn to it during the test and refer to that page. Okay, so those are the income forms, and we'll come back to those in a moment. So now down below that, I've got this line right here, and what I mean by that, on this line down, these are other types of tax forms that come into play in a business situation. But typically, these are going to be employment law forms or payment to contractor forms for services or wages that are owed by the employer. So these are payroll tax forms or independent contractor forms. And these are totally separate from income taxes. And these are the type of forms that you have to file when you have employees on a payroll. At the end of the year, you've got to provide them with W-2s and that kind of thing. So we'll look at those here. But I want to start with the top four. Or actually the top three here. So on the top, we have a 1040 form. 1040 form is an individual form that is filed for a sole proprietor or a single member LLC, unless you've elected to be an S corp. So a 1040 is your normal income tax form that you would normally file on April 15th every year to report your wages and everything else. You're going to have to file a 1040 form of some type. It may be a 1040EZ or some other type of 1040. But as an individual, if you've made any money, you have to file a 1040 form. Well, there's threshold. But if you make over the threshold, which I want to say is $600, you have to file the form. So in business environment, you're going to file a 1040 form along with a Schedule SE for self-employment to report for Social Security. Now, I'm not really going to go into that one too much, so I want to focus on these other ones. So let's look at the corporate tax return on page 76. So this is an 1120 form. An 1120 form is an income tax form for a taxable corporation. Not an S corp, a C corporation. So basically, these income tax forms are going to break down into these broad categories. And they're pretty much all kind of the same. So as you can see here at the top, and again, this is for a C corporation. The top part of the tax form is where you are going to report your income that was made by the corporation during the tax year. So gross receipts or sales, minus returns and allowances, minus cost of goods sold, gross profit, dividends, interest, rent, royalties, capital gains, etc. So that is where the corporation will file with the IRS and a copy to the state of Oregon to show the income that was made. That's gross income. And down below that are going to be the deductions. So from the gross income, you deduct these various different categories: compensation of salaries, wages, repairs, bad debt, rent, pay, etc., taxes. And you, of course, then minus off the deductions at the bottom down here. The total amount, you minus the deductions from the total income. And that gives you, as you can see right here on line 30, that is the taxable income for a C corporation. So that is where the C corporation has to pay corporate tax based upon that. So it's pretty straightforward. Now, it seems so simple, one page. This 1120 form also is going to have a bunch of background forms that you have to file, various different schedules, and it may end up being 40 pages thick by the time, or maybe hundreds of pages thick if it's a big enough company. But it's all going to kind of break down to these same: report the income, report deductions, and then that gives you the taxable income. Then you have to look up the tax. So let's look at the next one on page 77. Again, this is an 1120 form, but this is an 1120S form for an S corporation. Remember, an S corporation is a pass-through entity. That means that the net income is reported, and then the income passes down to the owners, and it will be divided among them based upon their percentage of ownership in the corporation, based on the number of shares. And then each individual owner will be responsible for paying tax on that income. They'll have to report that on their 1040 form. So basically, here's how it works. Again, it looks like a C corporation form, but there's a subtle difference. So again, you have your total income. So let's just say we had a total of $1 million of gross income. And then you have your deductions. So let's say we have $900,000 of deductions. So this is where we then have, instead of taxable income, remember on the 1120 form it said taxable income. This is the 1120S. So it doesn't say taxable income. They use the term ordinary business income or a loss if you end up having a negative year. So in this case, we had $100,000 of ordinary business income. Now, procedurally, what will happen then is when the taxpayer, you have to file this S corporation tax form by March 15th, which is 1 month before you have to file your individual 1040 form. And there's a reason that you have to file the corporate form first, because the purpose of the 1120S form is an information return. So you are providing the information to the Internal Revenue Service and to the State of Oregon Department of Revenue to tell them, okay, this S corporation, it's not a taxable corporation, but there is $100,000 of profit. And that then goes to the IRS and the Department of Revenue, and that way they know 1 month later when the owner has to file their individual 1040 income tax return, the owner must report their percentage of this net profit on their 1040 form. And the way that that's done is the S corporation, this is also true of a partnership, will issue to each shareholder, each owner, a form called a K1. I don't have that in your book, it gets to be too detailed. But the idea is a K1 form is a form that is issued to each shareholder that tells the shareholder what amount of money, based upon their ownership, they have to report on their individual tax return. So if we had 50-50 owners in this corporation, the corporation would issue a K1, they'll provide a copy of the tax return to each shareholder, and then also issue a K1 form to the shareholder, and that is telling the shareholder how much they have to report on their 1040. So it's kind of like a W-2 statement for wages, only it is for corporate distributions. Okay, so what's the difference? C Corp, taxable. S Corp, it's not taxable, it's a pass-through. So this S Corporation form is a form that we call an information return. It's not taxable right now, but it will be when the individual taxpayers file. All right, then the next form we have is a 1065 form. This is a return for a partnership. So this is similar to the 1120S form. Remember, a partnership is a pass-through entity, much the same as an S corporation in that respect, meaning that a partnership will not be subject to income tax at the partnership level. The profits are distributed out to the partners, like in an S corp, and then the partners will have to report the profit on their individual returns. So again, this is a 1065 form that is an information return. So you're going to file it with the IRS and the Department of Revenue to let them know what is the profit that needs to then show up later on the individual taxpayer. So same format. You have your gross receipts up top, your income. Then you have your expenses, and the accounting rules for corporations and partnerships are different, but we won't go into that here. And then again, down at the bottom, just like we saw on the S corporation return, not taxable income, ordinary business income. So that's the amount of profit that the partnership had, and then the partnership will issue a K1 to the individual partners so they know how much to report. And this is true for even a big limited partnership. Limited partnerships are common in oil and real estate and minerals and those type of activities. They may be publicly traded. There are various different partnerships that you can buy in, like shopping malls or office buildings or oil fields. And you buy a little bit of a partnership, it might be 1/1000th of a percentage. And then you'll get a K1 representing your partnership share each year. That's really common. All right, so what I want you guys to know is, oh, and then I forgot, sorry. And then finally we have the 1040 form that I keep talking about. And again, this is for an individual taxpayer. Boy, that's just out of focus. Let's see if I can do that. Okay, so this is what you're going to file yourself. There may be a version of this. It's not quite so detailed, but down here, this is where you're going to report your wages, how much money you made working based on your W-2, other type of taxable interest. Maybe you made money on a loan or something. And then here's where you qualify your, file for your dividends, and then also if you had other type of income. So this is where you're going to report your distributions from the S corporation or your partnership that you are a part owner. That's going to show up on your 1040 form, and then that will be your income that you'll have to pay tax on. All right, so again, back to page 72. So we have the 4 basic income tax forms, the 3 I want you to know about for testing purposes, 1120 for a C corporation, 1120S for an S corporation, and then finally the 1065 form for a partnership. Now, I'm not going to go into detail and make you have to fill out the forms or anything. That's a whole different class, right? I just want you to have a general understanding of kind of how these tax forms work and how they interrelate. So if you know that much, you'll be fine. Now, let's move on to the bottom forms here. The bottom forms are based on payroll. So these forms have something to do with either you're paying somebody to work for you in some manner, either as an employee or as an independent contractor, or you're reporting money that you made that you also then have to pay not just income tax, but because you're self-employed, you have to pay, what is it, self-employment tax. So these forms are based upon payroll, payments that are made in some respect for work that has been done, or if you're self-employed. So first of all, I want to talk about the concept of what is employment. And just down here at the bottom, the concept of an independent contractor versus an employee, because this is a big issue now. Well, it has been for years, but we're seeing it a lot more as a huge issue now with the gig economy and also the remote work, and then the type of businesses like Uber and whatnot, DoorDash and all the different type of big companies that hire people to drive or deliver or do typing online or that kind of thing. So here's the basic idea. When you want to pay somebody to do work for you, there are 2 ways that you can classify that person. One is as an employee. If they're your employee and you are their employer, then employment law kicks in and you have responsibilities, legal responsibilities for how you pay the employee and withholdings that you have to make on the money you pay them, and then how you report that. The other way that you can hire somebody to do work for you is as what's called an independent contractor. The concept of an independent contractor is they are not your employee, but instead they are working under a contract for you to perform some type of activity, a service, whatever it may be. And because they are an independent contractor and not your employee, you're not their employer, therefore you don't have the same obligations under employment law that you do if they're your employee. So you don't have to do withholdings and those kind of things. So it's cheaper from an employer standpoint, both monetarily and also in terms of the paperwork that you have to do, to classify someone as an independent contractor. And I'll show you a little bit more on that as we work our way through. On the other hand, you don't really necessarily have that option as an employer, because even if you and the person that's working for you agree that they're an independent contractor, the law ultimately will dictate the relationship. And it often occurs in an audit, which may come from different forms. Either the employment department or a workers' comp company may do an audit, and they may determine that you misclassified a person as an independent contractor, and where instead they should have been an employee, and therefore you were not in compliance with your payroll rules, workers' compensation rules, and other type of employment law, and therefore you've got a big problem now because you're going to get hit with back taxes and penalties, and maybe even have, if it's done on an ongoing basis, or might be even criminal activity there. So you've got to be very careful in how you classify someone, because if you're wrong and you're the employer, it can be very expensive and even put you out of business. So how do you determine? There are various tests, but I really break it down into 3 major components. If you look at there's one called the 12-part test that It gets basically 12 different points. I break it down into 3 broad categories on how you can tell whether or not somebody is truly an independent contractor or really they're an employee. And I will tell you right now, for the most part, especially in Oregon, the presumption is that if somebody's doing work for you, they're your employee. You start with them being an employee, and then the burden is on you as the employer to prove they're not. So here's what we're looking at. So number 1 is called the right to control test. And this is a conglomeration of various things, but this is the idea that in a true employer-employee relationship, I, as the employer, can control the means, methods, timing, etc. of your work. I can tell you where to be, when to be, what hours are going to be, how and where, if you're going to wear a uniform. Basically, I control your work and how you're going to do it. In that case, you're my employee, because that's one of the tests. If I can tell you what to do, that's part of being an employee. Independent contractor is different. So let's say you hire me to design your website. And I'm a website designer and I do this for other people. And you're going to pay me X amount of dollars to design your website. And you want it delivered by January 1st of the coming year. So you're going to pay me the amount of money, maybe a deposit down, and then the balance upon completion of the website. Now, you don't care when or where or how I go about designing the website. You want it to have the various components that we've agreed on, but you're leaving it up to me. If I want to work at it at 2 in the morning at home on my laptop wearing my pajamas, that's up to me. I'm the contractor, so long as I deliver what I've contracted to do. If I want to use a certain web program or page builder or whatever, if I want to code it myself or use pre-existing code, that's up to me as long as it delivers, based on the specifications of whatever the contract is. So that's not really right to control. I control my own work. So that's one of the things we look at, the control test. Part 2 is, are you using your own equipment? Or are you using my equipment? If you're using my equipment, typically you're my employee. You're not a contractor. If you're a contractor, you're typically going to have your own equipment, your own tools, and whatever is needed for the job. Now, if it's a specialized thing, there's, again, there's wiggle room in all of this. But I'll give you a classic example. In truck driving, it's very common to have a truck driver own their own semi-truck. And they may do work for multiple different companies. They may own their own trailer, and then they contract out to do a load. They may do multiple different trips for the same company as an independent contractor. It's called an owner-operator. And so you own your own semi-truck, your own trailer, you pay your own fuel, you pay your own insurance, you have a commercial driver's license, perhaps you even have your own trucking license for interstate travel, and then you just work for me on a load-by-load basis. As opposed to, you're driving my truck that I own in my company, and I'm paying it per mile, and you're not paying for fuel or anything like that, and I'm telling you where and when to be. In that case, you're going to be a company driver, my employee. So which or whose equipment are you using? Again, that varies from case to case as well. And then finally, the bottom one, which I think is probably one of the most important factors in determining if you're an independent contractor, and that is, do you do this type of work for other people? Are you separately organized, perhaps as your own LLC or S Corporation or C Corp? Are you advertising? Do you have your own company name? Do you have a web page? Do you do this type of work for other people, not just me? Do you have your own location, your own office, all those kind of things? In that case, if you do that, you work for lots of different people building web pages, that's more like an independent contractor. So those are kind of the three main categories we look at. When in doubt, if you're not sure, the safe method is to declare the person to be your employee. Now it's going to be more expensive because you now have to comply with all the payroll rules, but ultimately if they get hurt on the job, you've got workers' comp, that way you're covered, you're going to be in compliance with the law. One of the big issues with independent contractors, and the reason why this is such a big issue is number one, workers' compensation. If they're truly an independent contractor and they get hurt on the job, for the most part, you don't have to cover them with workers' comp because they're their own company, they're not an employee. Now there's some exceptions to that, but for the most part, you don't have to cover workers' comp or do other type of withholdings and things. All right, so let's move on. So let's assume that somebody is an independent contractor versus an employee. In that case, you have to report every year how much money you pay to the independent contractor by issuing them what's called a Form 1099. And the rules for this vary, but right now, if I remember, it's if anything over $600, you have to issue a 1099 to the person. And that is a form that's given to the person and also to the Department of Revenue and IRS to report that you paid them. That way they know that the person that received that money better be reporting that on their own tax returns. That's the whole purpose of a 1099 form. Now I'll tell you this, they change the rules on 1099s all the time. Those have to be filed by the end of January for the previous year. So you don't have a lot of time when the new year rolls around. You've got to go back and look through your books and make sure that you've got contact information for everybody. So if you are going to hire somebody as an independent contractor, when you engage their services, make sure, first of all, you have their address, their full legal name, and also make sure you have their tax identification number or social security number, because that has to be included on the 1099 form. And it's kind of a headache to get after the fact. So get that right up front if you are going to hire an independent contractor. It should be part of the actual contract itself. All right, now, if they're your employee, it's a whole different thing. So if they're your employee, you're now going to have these various different payroll forms. So, page 73. This is my highly abbreviated payroll spreadsheet, just so I can kind of show you how this works. So let's say I have an employee and I'm going to pay them $1,000 a month. So let's just say it's a salary. So when I pay them $1,000 a month, I'm not going to write a check to them for $1,000 because I have to do withholdings on their wages. Now, again, this is highly simplified. There are actually additional withholdings you have to do, such as transit tax and that kind of thing, but we're going to keep it simple for right now. So the first thing I have to withhold is federal income tax from the employee's wage. And in Oregon, we have a state income tax, so we also have to withhold state income tax. Now, the amount of tax that you have to withhold will depend on various factors. And this will be determined by the employee telling you how many withholding exemptions they want to claim. So the way that this works is a person will fill out a form to tell you, W-4 form, to tell you how many withholding allowances they want to take. And this is based upon that person's family status, if they have children that they're going to deduct, if they have other business deductions. And so essentially, the more type of deductions that you possibly have, the less amount of money you have to withhold from your wages, okay? So the more deductions or exemptions that you claim, the less money has to be withheld from that person's wage. With zero, of course, being the most tax that is withheld. So I just want to show you kind of how this works. So let's say I have an employee, they're going to be paid $1,000 a month, and they're claiming zero exemptions. They're single, they want to withhold the maximum amount of tax. so they don't have to, so they get a refund instead of having to cough up money every year. So you want to make sure you hold that back. So I'm paying them $1,000, so right here, I go down, $1,000 to $1,040, and I'm going to pay them withhold $85. So you can see on the payroll next door here, where'd it go? So that's where I got that $85 from, that table. Now again, in the real world, most people use payroll software and that will calculate it for you. But if it ever fails, this way you know how to do it yourself. Then I have to also do that for state of Oregon. So if you look over here, state of Oregon, same thing. We have our little chart here. We have a person that's not married and they have 0 exemptions that they're claiming, and therefore I will withhold $67. All right. So the next exemption, or the next withholding, back to my little payroll chart here, are Social Security and Medicare, Medicaid withholdings. Social Security is federal-run operation for sort of retirement, and Medicare, Medicaid is for health benefits, public health benefits. So the way that it works is, yeah, go ahead.
On regular payroll taxes, do they separate the Medicare and the Medicaid, or do they combine them?
It's combined, yeah. So the way that this works is the total tax that has to be paid is split between the employer and the employee. So for Social Security tax, it's 12.4% combined. And for Medicare, Medicaid, it's 2.9%, although that can also go up depending on the person's wage level. There's a kicker that kicks in. So combined, that's 15.3%. 15.3%. So when I pay somebody, they are responsible from their own wage to withhold 6.2%. I, as the employer, have to withhold that from the money I pay them. And I, as the employer, have to match it. In addition, same thing for Medicare and Medicaid, it's split 50-50, 1.45% each for combined 2.9%. Again, I have to match it. So the match is coming from the employer's own money. The employee share is coming out of that $1,000. So the way that that works is when I pay the employee, their net is going to be lower, of course, because I'm doing all those withholdings. Now, where is that money in the real world? This money that I'm withholding as the employer is sitting in my checking account, in my business checking account, along with the match that I have to come up with my own money. So depending on the size of your payroll, you may be a weekly reporter, a monthly reporter, or some other interval. I myself am a monthly reporter for payroll, so every month I have to withhold because I pay on a monthly basis. And then you have to immediately deposit those amounts with either the federal government, Social Security Administration, or the Department of Revenue. And that will depend on the amount of your payroll. You also have to deposit this amount as well. And so that's done typically on a monthly basis. So in the real world, if I'm hiring somebody for $1,000, it's actually going to cost me $1,000, in this case $76.50, to have that person as an employee. Now that doesn't include, we also have workers' compensation, we have other types of withholdings depending on where you're at. So here in Oregon we have a statewide transit tax. If you're in Multnomah County or a TriMet area, there's TriMet tax. Lane County has Lane County District Transit tax. So there are some other taxes which I haven't included. Workers' Comp Benefit Fund. I don't want to keep it simple. Okay, so how do you report this? So that brings us back here. So first of all, every quarter, you have to file a 941 form. A 941 form, I'll show you that, it's on page 93. Okay, so this is a quarterly employer report, so every quarter, first quarter, January, February, March, etc. So I have to tell, this is with the federal government, we have a similar one for state of Oregon. I have to tell how many employees I had, what the total amount of the wages that I paid, and then we have to do how much money I withheld from those wages, and then we have to calculate the Social Security, and here's where you see those numbers, and wages and tips, and then total amount that's owed, and then it's going to say how much, down here at the bottom, how much deposits did you make. So this is where within, I want to say it's 10 days of your payroll, you have to make those deposits. And then how much more you owe, or if you've overpaid, how much you overpaid. So this reconciles every quarter with the federal government how much you paid out. And then the next page you have to do another month-by-month reconciliation, and they cross-check all these numbers. On the state side, you have to file what's on page 95. This is state of Oregon. And this is called a Form OQ, which stands for Oregon Quarterly Payroll Tax Return. So same thing, number of employees at the top. Boy, that's just so bad. And then with Oregon, the federal as well, we have unemployment insurance that the employer will have to pay based upon their tax rating. And then here's the amount of state withholding, so that's how much money I withheld from my employees' wages. The unemployment insurance is paid by the employer based on the total payroll, and then this is how much I withheld. So I have to report all that, pay the unemployment tax, and here's where the workers' comp benefit fund, which is an additional tax. So total amount that I have to pay. Now again, these have to be filed every quarter. And you also have to list out every single employee on Form 132, how much you paid each individual employee, how many hours they worked, and all that. So these are very detailed. I mean, and these take a lot of time to do. Again, if you have a payroll service, they'll do that for you. And I think it's a really good idea to do that because these are can get very complex really quickly. In addition, they cross-check all these forms. And so the numbers better match up with each other. And that's where, when I say they, the IRS, Social Security Administration, State of Oregon, they're on this for the most part because they have computer programs that cross-check down to the cent. And it's pretty common that maybe you transpose 90 to 0.09 on the cents or something, and your numbers are off, they'll let you know right away. You're subject to a penalty with interest if you got it wrong. Okay, then, it's not over yet. There's more taxes, don't worry. Then, every year, you have to file an annual return, which is the 940 form. Have that on page 91. And this is very similar. This is where you're going to add up the total amount of wages that you paid, total amount of employment, and then you're going to determine your FUTA, which is federal unemployment tax. And you'll have to pay federal unemployment tax. So this is an annual return that combines all of the quarterly amounts. All right. Next we have W-2 and W-3. A W-2, go to page 87 here. You guys are probably familiar with this. If you've done work before, you'll get one of these. So this is a wage statement that must be issued to every employee by the end of January for the previous year to show how much the employee made, total wages, how much was subject to Social Security, how much tax was withheld, federal and state down here, tips that were dependent care benefits that are subject to potential tax, health insurance benefits, other kind of things. So the idea of a W-2, W for wage, W-2 form is, this is for every single tax or employee. And then they'll file that with their tax return to determine if they owe tax or will get a refund. So you have to do one of those for every single employee, and then you also, as the employer, have to do a W-3 form. And you've probably only seen a W-3 if you're doing payroll as an employer. The W-3 form is the all of the W-2s combined into one form. So you have to provide a copy of the W-2 and the W-3, which is a summation of all of those W-2s. Now, you know, if you've got 500 employees, that's a lot of paperwork, even a dozen employees. And again, those numbers better match what's on the employee W-2, and they better match your quarterlies and your annual returns because they cross-check all this stuff. So that gets filed along with copies of your W-2s. You have to send that to the Social Security Administration by the end of January of the year or before. All right, W-4, next page. I'm not going to spend a lot of time on this. This is they've come out with a new version of this, which is a lot longer. But this is when you hire an employee or when they want to make a change to their withholding amount. This is where the employee will fill this out and tell you as the employer how many exemption allowances they want to have, so you can calculate how much to withhold on that table I showed you. And again, if it's you, if you want to withhold the max, you put 0. You also have the option to write in an additional amount that you want to have withheld. So if you've got income from other things, and you want to make sure you paid in enough, you can do a 0 withholding plus an additional whatever amount you want. And that's pretty common if you're self-employed, to withhold more. Okay. And I think that about covers what I want you to know about. So one other thing here, back to independent contractors. So when you report income for an employee, you file a W-2 form for wages. An independent contractor is a 1099 form. Do not give an independent contractor a W-2 and then try to claim that they're an independent contractor. I've seen that happen before. You just messed up big time. You might be able to fix it, but you'd have to have really good evidence. Because a W-2 is what you give to an employee, not an independent contractor. A 1099 is what you give to an independent contractor. And so that's one of the first things they'll do in an audit is look at, okay, how did you report it? You gave them a W-2, but then you said they're an independent contractor. You're kind of at odds with your own argument. So just be aware of that. All right, are there any questions on these tax forms? I'm not really going to test all the payroll stuff. I do want you to kind of have this understanding of an independent contractor versus an employee. And then also your basic obligation to do withholdings, as an employer. All right, well, we're going to break there because we're almost out of time, so we'll pick up more next week.